Good morning, good afternoon, or good evening, wherever you are today. Thank you for being with us. My name is Neil Kashkari. I'm president of the Federal Reserve Bank of Minneapolis. We're really pleased to have you join our conference on how do we empower the public to run stress tests on large banks. We have a terrific lineup of speakers today. I'll introduce our keynote speaker here in a few minutes. I just wanted to give you a little bit of an overview about what this conference is about, what has motivated us, and what we hope to get out of it. After the 2008 financial crisis, a lot of work has gone in to try to improve the resilience of our banking sector because banks were at the center of the 2008 financial crisis. The Federal Reserve and other regulators have increased the capital requirements on large banks. They've made sure that the liquidity is stronger, that the banks fund themselves with longer term funding. They've also implemented stress tests, which is running tests to see if a shock hits the economy, do they have enough resilience to withstand that shock and continue to lend to support an economic recovery? And today's conference is focused on how do we help the public to assess through their own stress testing whether or not banks have enough capital to withstand different economic shocks. Now, at the Minneapolis Fed, since I've been here and maybe before, we've argued that the biggest banks need a lot more capital to make sure that they can handle big shocks that could come, so that they don't need future bailouts the way they received a bailout in 2008. Well, we've been doing this work, and our colleagues around the Federal Reserve System have been looking out for different shocks that could be coming at the US economy or at the global economy. And the nature of these shocks is, unfortunately, you rarely see them in advance. If you saw them in advance, you would take some action to try to protect yourself against that shock. So although all this work was going on, really smart people looking around the world for different shocks, then of course what happens? The COVID shock hit us. 9 months ago, a year ago, none of us were really thinking about a pandemic hitting the US economy and the global economy with the kind of force that it had. So here we are, we're in the middle of this pandemic. Actually, early on when the pandemic hit us in March, April, you saw financial markets freeze up, you saw the Federal Reserve and other central banks act very, very aggressively to stabilize the financial system, to keep credit flowing. And one of the things that struck me sitting on the Federal Open Market Committee is how wide the range of possible outcomes were that could come from this COVID shock. Was it going to be a short-term downturn, a couple months, and then reopen the economy and just a very quick recovery? Or would it be a prolonged, deep downturn with tremendous loss of health and loss of life, but also economic costs? When millions of people lost their jobs, that could potentially put huge strains on the banking industry, because if homeowners can't pay their mortgage because they lost their job, or they can't pay their rent, can't pay their credit card bills, can't make their auto payments, those losses then roll up into the banking sector. And so back in April, I published an op-ed in the Financial Times where I said big banks should raise capital now, because the possible losses that they could be facing, depending on what happens with the COVID pandemic, could be massive. And that a way for banks to inoculate themselves, in a sense, was to raise capital while they could, to make sure they had enough buffer to withstand these losses. But the point was, the range of possible outcomes was enormous. And nobody knew for sure. Even today, nobody knows for sure how long this pandemic is going to go on and how deep the downturn may be, what losses are yet to come. So at the Minneapolis Fed, we started looking at, instead of just using our own judgment of what the one scenario is that could be the one downside scenario, what if we gave the public the tools to run their own scenarios? And the New York Fed actually has, for a number of years, published a public stress testing model on their website. And we said, well, what if we took that public stress testing model and made it available to the public so they could run their own scenarios and then render their own judgments about, hey, are the Federal Reserve stress tests rigorous enough? Are the bank stress tests rigorous enough? Or does the public want to run its own stress test? So in the spirit of transparency, in the spirit of equipping the informed public, academics, researchers, policy analysts, as well as investors, give them the tools so they could run their own stress test. So we put this on our website. We created this tool so that the public could run their own scenarios. And the purpose of this conference today is to get feedback on the tool that we've put out there. How do we make it more useful? How do we give more transparency to the public and to scholars and academics and to investors so that they can run their own models and render their own judgments on the health of banks. So I'm going to just spend a minute. I'm going to share you my screen and show you how this tool works. And then we're going to get into the actual discussion. So let me see if I can share my screen. Here we go. Okay, so you should see, this is the Minneapolis Fed's website, minneapolisfed.org. I'm going to go up here to the banking tab and click COVID-19 stress test tool. And here it is, COVID-19 stress test tool, run your own stress test on banks. So if you scroll down here, we put in place here 5 different scenarios that one could pick. In an ideal world, users could put in all their own data, all their own scenarios. But for each of these, if you, for example, real GDP growth, unemployment, 3-month T-bill yield, if you go down here, each of these is a path. So there was no way for us easily to say, hey, enter your own path for each of these different items. So we just pre-picked a bunch of different scenarios. So you can click severely adverse scenario, and it'll update all of these data points here, all of these different triple B bond yield, CRE prices. And then over here, you can see what ends up happening to the capital for large banks. And even though here, if you look at this one, this severely adverse scenario, on average, they don't breach the minimum capital threshold. You can see that 7 of the firms actually have capital projected to go below their individual thresholds. So here's where the heterogeneity of the banking system is really important. And you can vary it. You can go to a U-shaped scenario. You can go to a severe U-shaped scenario or an extreme U-shaped scenario. And here you've got 12 firms with projected capital below their individual thresholds. And then you can pick individual ones. If you like the 10-year note yield from the baseline, you can do that. If you like CRE price index from the baseline, and then the model will update in real time to give you a sense of how severe it is. So this is a first attempt to take this New York Fed's publicly available model using public data and allow users to customize different scenarios. Again, ideally, we would allow users to completely define their own scenarios, but it ends up being hard to find an easy way to input all of these different paths. So this was just one way that we have come up with doing it. So the purpose of today's conference is to look at how can we arm the public with more data, more analysis, so that they can use their own judgments. They don't need to take Neil's scenario as the baseline scenario or the Board of Governors stress test scenario. Users ideally can run their own scenarios to ultimately determine whether or not banks are safe and sound and resilient enough to withstand either this COVID shock or potential future shocks to come. So with that brief introduction of why we're here, I'm thrilled to introduce our keynote speaker, who I'm going to join for a Q&A session after he offers his remarks. Sir John Vickers is our keynote speaker today. He has been warden of the All Souls College in Oxford since 2008. He studied at Oxford, where after a period working in the oil industry, he taught economics and was Drummond Professor of Political Economy from 1991 to 2008. He was chief economist at the Bank of England and a member of the Monetary Policy Committee from 1998 to 2000, and Director General and Chairman of the Office of Fair Trade from 2000 to 2005. In 2010, he became chair of the Independent Commission on Banking, which was founded to consider reforms to the UK banking sector to promote financial stability and competition in the aftermath of the 2008 financial crisis. He's currently president of the European Association for Research in Industrial Economics. His research interests, which combine theory and policy, mainly concern competition and regulation. Sir John Vickers, thank you so much for being here today. I now turn the floor over to you. Thank you.
Thank you very much indeed, and for this wonderful invitation. I can say good afternoon to everybody, given where I'm sitting in my time zone. So I want to talk about stress tests and transparency, and what you're doing is, I think, quite an important illustration of a step forward that can be taken in this this whole area. Now, I want to take us back to it's like a prologue. I want to talk about models and transparency, indeed, in the context of monetary policy, because as you mentioned in that very kind introduction, 20 plus years ago in the late 90s, I was chief economist at the Bank of England. It was the early days of independent monetary policy in the UK. A big question was whether we at the bank should be transparent about the core macroeconometric model that was at the heart of not the only ingredient, but it was central to the forecasting process. And there are a number of good reasons it seemed, no, we shouldn't be too transparent about that. First of all, we use many models, not just the one. We don't want to mislead people, think there's one big engine that determines everything. Second reason was it's actually the committee, and it puts assumptions into these models. They make a judgment about the projection for inflation, for unemployment, for growth, and so on. It's not all delegated to some model. So again, it would be misleading to attach too much significance to that. And then there was a sort of terrifying thought that if we do publish the model, like at the end of The Wizard of Oz when the curtain comes back, what if what was behind the curtain did not withstand scrutiny of academics or others? But of course, these are not good reasons for opacity. If you use a number of models, then you should say that and put them in context. You should explain the relationship between models and the committee. You shouldn't leave misapprehensions to be out there. And as for the terrifying thought, well, that is obviously a reason for transparency, not against. Because if under criticism, the model can be improved and it's important in the policy setting process, then the sooner that comes to light, the better. So we did publish this model, and I actually found on my shelf, there is the book, 150-page book, equations. There are 6 different models in there. This is back in the days when books were made out of paper. And not only did nothing bad happen, but we did get criticism, most of it constructive, which is helpful. And the eve of publication process was itself very healthy internally, both in enhancing understanding within the institution of the model, and it led directly to some improvements. So against that background, 20 years ago, monetary policy, UK, not the US, that all inclines me to welcome the steps that you're taking, the board in general, making its model public, and you with your initiative recently, democratizing the stress test tool. That is something which I feel very inclined to welcome. And of course, it's in a context where the actual shock that has hit all our economies is generally greater than any of the assumed shocks that were fed into various stress tests that have been run in recent years. And indeed, I would say that stress test transparency and model transparency around it not only is every bit as important as the setting I began with, monetary policy, but more important still, because there is a fundamental incentive problem involving stress tests, which in a way is obvious, but let me spell it out. It's that the subjects of the test are not only the banks, but they're also the regulator, the supervisor of the banks. Because a regulator who's got the duty of ensuring safety and soundness is manifestly failing in that duty if, when plausible stress tests are run, major banks under its supervision fail those tests, unless there's some very good reason why they do so. And indeed, public failure could not only damage the reputation of the regulator, could even be directly detrimental to financial stability objectives if confidence in banks gets dented unduly. So with a stress test, which are generally run and publicized by the supervisors, the regulators themselves, we do have a setting which is being characterized as the regulator setting the exam, marking their own performance as well as that of the banks. And this is a clear and obvious incentive problem. So how can we address it? Well, one approach would be to have stress tests run by a separate body, an independent body from the supervisor or the regulator. Well, not clear who that should be. And the supervisor is at a special informational advantage in running these tests. So that seems to me good reason why the prime tester, the tester in chief, should be the regulator despite this incentive problem. But a second way to try and address the problem is transparency. Demonopolize stress testing. That makes it easier for others, whether they're academic institutions, investors, or members of the public equipped with a tool like the one you've shown, easier for them to run their own tests in parallel. They can put in alternative assumptions and so on. And that all allows closer scrutiny of what the tester in chief, the supervisor, is up to. So I think that's for the good. It needs to be carefully explained, but in proper disciplined context, so things don't run riot. But I think that's a degree of of openness, pulling back the curtain, which is a good thing to do, and I wish there were more of it. Second measure, related, and I'm going to talk about that in the remainder of my remarks today, is to allow the assumptions that go into the tests not to be monopolized by the regulators. Allow others to pick other assumptions. And again, that's what your tool is one way of doing. And I'd like to make a few remarks about the importance of market-based measures in running stress tests, because a campaign which I've been on in recent years with no success at all is to try and encourage the central bank where I am, the Bank of England, to run stress tests not only on the regulatory numbers, the accounting numbers, but also in parallel on more market reflective measures of capital. And I want to explain now why I think that's important to do. So stepping back, a stress test has essentially four ingredients: specification of how much capital the banks have to begin with. Second, how big is the stress, the shock applied to the system? Third, what's the relationship between the size of stress and capital erosion in the banks? What's the sort of coefficient of capital erosion? And then finally, this is the sort of orange dotted line on your charts, what counts as an adequate post-stress amount of capital? What's the pass mark, if you like? And market-based measures can inform the setting of a number of these components. And I want to focus on the first, in particular, this proposal that for banks with price-to-book ratios less than 1, south of 1, stress tests based on market values should be run and published by regulators with explanations alongside the existing stress test results. I'm not saying scrap the way we do it now. I'm saying be pluralist, do it in parallel, or put it in an appendix, something like that. Now, why does this matter? And I think this is more of an issue outside the US than within the US. Here is a chart from the 2 years ago IMF Global Financial Stability Report. The US is in red, and you see that the price to book ratios over the post-crash period, the crash of 12 years ago. If I can stay on that previous one, please. We've had the US on average price to book ratios north of 1. The 2 years ago, that was about 1.5. But in Europe and in Asia, we've had price to book ratios, even for the averages of those regions, less than 1, indeed sometimes a long way below. And the next chart, which is from a few months beyond that, it's from April 2019, what that next chart is going to show us, if it comes up in just a moment, this will depict both the official measures, the Tier 1 capital ratios, and the price to book ratios, respectively, on the vertical and horizontal axes. So the USA is the big blue blob that has price to book ratio towards 1.5 on average, whereas you'll see a lot of the blobs for European countries like Germany, for Asian countries, Japan and others, price to book ratios, even then, this is a year before COVID, price to book ratios, in some cases, about 1/2, and that's on average for those regions. So some institutions within those regions, because of dispersion around the average, would be lower still. Now that's a year before COVID. Let's do one more chart, which is the last chart I'm going to show. This is from the IMF publication 6 months ago. What the IMF has been doing, and I credit it for that, it's been showing some market adjusted capitalization. So for banks where the price to book ratio is below 1, it's applied a market-based multiplier less than 1 to the capital level. And if you apply that, you get this spread here. And another nice thing about this chart is it compares spring 2020 with the crisis of 2008. You see in the dark blue, the US banks on these measures considerably better capitalized than then, but Euro area, other advanced economies, including the one I'm sitting in, China, emerging markets, it's not at all clear that we're in better shape now than at a comparable sort of point, though it's very hard to make these comparisons, in the period 12 years ago. And again, if you look at that, you'll see on the market adjusted measures, the capital in relation, equity capital in relation to exposures is often 2%, maybe 2 to 3%, which corresponds to leverage of 30 to 50 times. And indeed, there are some very well-known banks where on a market-adjusted basis such as this, you would get leverage north of 50. And as was said in Neil Kashkari's opening remarks, this is with a very big spread of uncertainty in front of us. We can't comfort ourselves by saying, oh, we've had the shock, now we just get through it. There's a big spread of uncertainty because of the pandemic uncertainty before us. Now, why does all this matter? We don't need the charts anymore, I think. Thank you very much for them. Why does this matter? Well, if the market took the same, believed, in short, the regulatory numbers, we ought to expect price to book ratios in excess of 1, because the market value is reflecting the market's judgment of the value of current assets less liabilities, plus the franchise value of future business that the bank has not yet entered into. And if you've got competent management, that'll have a net present value in positive territory. And then there's the option value of equity relative to debt, particularly if there are bailout possibilities. So for all these reasons, you'd expect normally, if the market believed the accounting values, that we would have that ratio in excess of 1. Yet we've seen in Europe and in Asia for a number of years since the crash, never mind the last 6 months, things well below 1. And even, I'm not being a market fundamentalist, I'm not saying the market's necessarily right, but it does, I believe, raise the possibility, serious possibility, that the accounting measures are not an accurate snapshot of where we are. And when you're doing a stress test, such an important thing is where you assume the starting point to be, that I believe that where price to book ratios are below 1, that we should take them seriously and look at parallel stress tests in conjunction with what the official kind of stress test generally shows. Now, when I suggested this, it's almost 4 years ago, to the Bank of England, there was a response. The bank came forward with some serious arguments as to why this would be a bad thing to do. One of their points was that the price to book ratios lower than 1 do not necessarily mean that asset quality is impaired. There could be other reasons why the market takes a depressed view of profitability in the immediate years facing the banks, and they're discounting that. And that, rather than weak asset quality, is what is explaining the ratio being less than 1. Well, that's certainly a possibility. If you have a price to book ratio of 0.8, 0.9, that indeed might be a reasonable argument. Still, though, the bank's obligations to depositors, to bondholders, those have got to be met by the future cash flows one way or the other. So I don't think it disposes of the question, but it may be a response to it. But anyway, I would say, fine, still publish the two in parallel and advance that explanation. Don't use it as a reason for a lack of transparency there. A further point I would add about starting point is the assumption that the stress tester makes about the no stress path of bank profits in the immediate years is also very important. A feature of Bank of England stress tests, which they've been transparent about sometimes, but not in every time they've run the tests, has been an assumed rising path of profitability in years 1, 2, 3, which creates quite a nice amount of capital, provided it's not paid out of dividends, to absorb the hypothesized shock. That too needs to be open, needs to be transparent, because if you take the view that ain't going to happen, even in the absence of a stress, then that's something you need to feed into your stress test too. And it's not completely separate from the point of view about low price to book ratios, because those ratios might in part be explained by market doubts of a profit rebound. Final point to discuss, and then I'll conclude. When I made this suggestion, Governor Carney, he was then the governor of the bank, one of the points he made to counter it was, well, but this might risk confusing the bank's communication around its stress tests. Quote, if we publish two sets of results that give different messages, this is all public domain, people might struggle to understand what we are trying to say about the resilience of the banking system. Now to that, I'd say, well, maybe, but message clarity and message unity should not have priority, in my view, over stress test rigor, where different bases of calculation, both reasonable, deliver different answers. And when people using the tool that you're advancing, get different results out of them. That is important for people to know. Let's hear the explanations of why those differences exist so that those two can be appraised and tested. Now, I can see it might be an awkwardness for the communication strategy of the stress tester if their strong aim is to say how solid everything is, to have these pesky people doing alternative stress tests or themselves having to run stress tests on alternative assumptions. But I think that's what accountability requires and what transparency desires. And it's a way of cutting into the incentive problem about the tester setting and marking their own exam papers. And if such transparency put a greater discipline on such pronouncements, I say that would be no bad thing. So to conclude, what are the policy implications? One, I do think stress test transparency is really important, and I admire the steps you're taking for it. If you don't have transparency, these tests can do more harm than good. I think they have possibly contributed in some countries to a questionable sense of security that banking systems were well capitalized pre-COVID, when that was perhaps not so clearly the case. I believe we should be aiming for much better capitalized than 2019 banking systems post-COVID. For now, though, we are where we are. And I would just say that as a holding measure, I'm very much in favor of banks not paying out dividends or other capital payments until this spread of uncertainty is resolved to something that looks more comfortable. Thank you very much.
Sir John, that was terrific. Thank you for that really thoughtful commentary. And it's really striking to me. I remember in the 2008 financial crisis when I was at Treasury, everybody was terrified about mark to market because asset values were plummeting, stock prices were plummeting. There were calls for the trading firms that had to mark their book to market. Some people were calling, suspend that. It's irrational. But when you point out that a year before COVID, there was this huge disconnect. I mean, it's one thing to say, we're not going to trust market values in the middle of a crisis, fine, fire sale. But a year before COVID, they're showing such a huge disconnect between the book values and the market values. That's powerful. I mean, I just don't find the counter arguments that were offered to you, I just don't find them remotely persuasive. And it's almost embarrassing that the official statistics are so far apart from what the market is telling us. Is there more to it? I mean, your argument to me is very persuasive.
Well, I'm delighted to hear that. The pro-cyclicality point that some make against the use of market measures is not lacking in substance altogether. And clearly it would be, I hope I was very careful to say it's where the price to book ratio is below 1. You certainly don't want regulation following market exuberance on the upside, where a market value is reflecting a lot of hoped for future profits with no tangibility at all. So I'm not saying be whipped around by the markets. I'm saying when the accounting numbers and the markets are saying different things, then if you're running stress tests, just look at things on both bases. Yeah. Don't assume either is correct at the expense of the other. Look at both, be pluralist, and I think that's what your tool allows. Another point I would make about the previous crisis is to advertise, as many people have done, a paper of Andy Haldane's, which was published in who's now chief economist at the Bank of England, published in 2010 or 11, which looked at how accounting measures and market measures evolved in the 2007 to 10 period, where the markets were as we now see, ludicrously exuberant pre-crash, but they tracked events in a much more timely fashion than the accounting measures did themselves. And the accounting measures were really poor at discriminating between the banks that ultimately did get into trouble and the banks that didn't get into trouble. They lagged events. So, be alert to these market signals.
Yeah, no, that's a great point. I mean, I remember when the Federal Reserve first introduced the stress test back in 2009, I was a treasurer. I just remember the Fed announced the stress test and stock prices got crushed because people were terrified about what they would show. And I was skeptical that they would be taken seriously so I ran the TARP program and I knew how much money we had left in the TARP. So I knew in the back of my mind, there's no way our stress test can conclude that banks need more money that is available in the TARP. That would be devastating. And it's also not going to be credible if no banks needed help. So the only credible answer is that some banks needed help and the total amount of help they needed was within the budget of the available TARP resources. That's the only acceptable answer. But I figured markets would realize that that was the only acceptable answer. And then when the answer was the only acceptable answer, they would discount it. But remarkably, it worked. That the answer came within the capacity and markets breathed a sigh of relief. And so I think the idea of stress testing during a crisis is very complicated because you don't want to add fear, but you also want to be credible. So the key to me is how do you do stress testing in advance of a crisis that is credible and that is informative? And that's why your chart showing the disconnect, a year or two before COVID is so very, very powerful. And it's hard for me to dismiss it. Let me just shift gears a little bit and talk about the risks of transparency. One of the things we've observed in America is that banks appear to be tailoring their balance sheet around the stress test. And it reminds me of Volkswagen, right? Volkswagen programmed their cars to detect when they were in an emissions test. Then they automatically turned down the power. They passed the emissions test. And once the test was over, they turned the power back on again and started emitting fully. Do you have any fear about banks gaming the stress test? And is there anything we could do to try to make that less likely or harder for banks to do that?
Well, one would hope that supervisors who are much closer to these institutions than any members of the public would themselves have a basis for assessing whether that's going on or not. Again, I think that market measures can have some merit because one can get the arguably, I don't know, one could get the balance sheet looking nice on the 30th of September or what it is, and of course the market sees that too, so they're not entirely separate points. But if there are fundamental doubts about whether loss recognition has been adequate in an institution, and if the market is reflecting those doubts, no amount of cosmetic accounting is going to remove that. So again, there may be some virtue. I don't want to oversell the market point, but there may be some virtue in that going on.
Yeah, and I see that, and I also think giving the public the ability to run their own tests whenever they want, using the latest data available, also may help protect against this kind of behavior. Let me shift gears a little bit. One of the things that, if you look at the stress test tool that we published on that website that I showed, one thing that tool does not include is it does not include fiscal policy. People have said, oh my gosh, look, the banks are doing great. They're this source of strength in COVID. Well, I say, yeah, they're a source of strength because the US Congress spent trillions of dollars to put money in the pockets of people who've lost their jobs. That's how they paid their credit card bills, their rent, their car payments, their mortgage. And so sure, bank losses are much lower than they would have been absent that fiscal policy. How should we think about fiscal policy as we think about banks preparing for downside scenarios? Because if banks can always count on the fiscal policymakers to provide support, then banks could say, well, we don't need more capital because Congress or the parliament is going to step in. I'm just curious, how do you think about that?
Right. Well, I think that set of issues partly educates the question of how big is the spread of uncertainties. Now, how the disease unfolds, that's all part of it. But the surrounding policy response to try and move the economic probability distribution to a better place and less uncertain, it comes in that way. But if you have a really prolonged pandemic, or COVID-20 follows COVID-19 or whatever it might be, there is a limit to the fiscal space. I think a very interesting thing at the moment is just how super low discount rates are. So, I agree with those who say that even at these historically, fairly high government to debt to GDP ratios, I think there is still fiscal road room. Monetary room, I mean, there is a limit to how far that could go. But the other comment I'd like to make on your remark is, we have seen a huge amount of indirect assistance to the banking system in the last 8 months. I mean, just enormous. As somebody who I must better not name put it to me the other day, said in 2008, it was the banks that got their clients into trouble. because of subprime, and it was the core banking system. Now it's kind of the other way around, which is what the business of banking is all about. If you have the travel sector, the retail sector, entertainment sector, and huge bank exposures to that, then that is going to come onto the balance sheets of the banks, unless somebody else takes that loss for them. And we've had massive government support, which I'm all for. I think it was the right response. But let's not overlook that banks have been, enormous beneficiaries of that up till now.
Yeah, both in terms of the fiscal support that we talked about, but also in the US at least, our financial markets were on the verge of collapse in March. Our funding markets, our overnight markets, our money markets, and the Federal Reserve had to step in. We stepped in, and I completely support the actions that we took. We stepped in much more aggressively than we stepped in 2008, and it was the right thing to do. But banks are kidding themselves if they're trying to pretend that they were not direct beneficiaries of that assistance. Again, it was the right thing to do, but if banks want to pretend that they've self-insured against these risks, that's simply not the case. And I think recent experience has shown that.
That was really remarkable to see, that stress on the treasury market. The deepest, most liquid market there is. And even though that was overcome, I do think where the yield curve is pretty remarkable. And what that means, including for other parts of the financial system, I think is a very interesting set of issues.
You've studied these issues, we're wrapping up, we have a few more minutes. You've studied these issues over a long period of time. When you think about the 2008 crisis and now this COVID crisis and what we've learned about financial resiliency, are there any big takeaways you have on what the work that's unfinished or vulnerabilities that we didn't fully appreciate? I'm just curious, you've been at this a long time, I'm curious what your thoughts are.
I think trying to spot the next vulnerability is all very well, but chances are the thing that's really going to bite you won't have seen coming. And it's odd thinking back even to the turn of this year. There was plenty of evidence that pandemic risk was a very real risk. I mean, we've had in the last decade or so a number that didn't become pandemics on this scale, but some pretty scary situations. So, but because you don't know what's going to hit you, that's why I'm all for really big buffers to begin with. And I think the Basel III settlement, particularly on equity capital, was way better than what we had before. Quantum of capital, quality of capital, resolution, it's all good. Will it work if the whole system is in crisis? Nobody really knows that. But I just think we could and should go much further. When the sun is shining again, we can just get to a much more resilient place. And there's a strange disconnect between nearly all the academic economists who've looked at this, who say, well, if you do it over time, where are the social economic costs of higher capital levels? And yet the benefits is insurance against crisis, particularly if the future world is a bigger spread of uncertainty than we thought it was. I think those arguments are really very compelling. So we can't do that right now because we're in this throes of this crisis, but I do think we need more ambition for when we get through it.
Yeah, I couldn't agree more. It's funny, I spoke to a senior central banker from Europe, who I'm not going to name, who's been doing this kind of work for many, many years, decades even. And I asked him, I said, do you think that bail-in debt will ever convert to equity? And he said, oh no, it'll never convert to equity. And I said, well, what's the point then? He said, well, we've done all that is politically feasible. And so that's one of the frustrations I have, is that I think the analysis is quite clear that the biggest banks do need more capital. We have taken important steps forward, just as you said, but we're reaching political constraints on how far we can go. That's not unreasonable for society to decide, but let's be upfront with the public that, hey, we're not doing what the science is telling us to do. We're stopping short of that because of perceived political constraints, and then let the people decide if they want to accept those constraints and impose those constraints, or if they want to do more. And so I'm frustrated that I don't think that we have been as transparent with the public about what the best science of the day is actually calling for versus what appears to be a political compromise.
We agree.
That's Nice, convenient outcome. Well, Sir John, this has been a wonderful kickoff to this session, a wonderful keynote speech. We really appreciate you taking the time. We really benefited from your many years of experience working on these issues. I want to thank you on behalf of my colleagues at the Minneapolis Fed for your contribution. And we look forward to continuing to work with you and sharing our ideas and hearing and learning from your latest thinking on these topics. So thank you so much.
Thank you very much.
So with that wonderful introduction, I'm now going to turn it over to Ann Safir from Reuters, who's going to introduce and moderate our panel of experts to give us their thoughts. Ann, over to you.
Thanks so much. So on this panel, our job will be to discuss, what tools the public could use to keep tabs on how safe the big banks are. And I have to say, when I first was reading up on this panel, it struck me as a bit of a scary topic, because the implication that, the public needs to keep tabs on the big banks, it's not enough just to assume that the banks themselves and the regulators are taking the steps that we need. So, and now that we're sort of months into this pandemic and we're headed toward a winter, and we don't know if things will get more difficult, it seems like transparency about the condition of banks and the ability to sort of check them out ourselves will become even more important. So with that, I just wanted to start with the plan for the next half an hour, I guess it is. Each of the panelists will speak for about 5 minutes, and then we'll open it up to a discussion and to questions from the audience, which is you. You can submit your questions using the Zoom Q&A at the bottom of the screen. So let's get started with our first panelist, Steve Chichetti. He's an economics professor at Brandeis University, and he's co-author of a really informative blog. I encourage you to check it out. It's called Money and Banking. So over to you, Steve, if you could.
Thanks very much. It's really my pleasure to be here, and I want to thank you, as well as Ron Feldman and Neil Kashkari, for putting this really great event together. Let me start with a few general comments about stress testing, and then turn to the Minneapolis Fed's tool and the class model, all in 5 minutes. The stress tests are, in my view, a powerful tool for safeguarding the resilience of the financial system. They are, I think, the most powerful, really, macroprudential tool. They take seriously the fact that when a large common shock hits, banks may not be able to sell assets or raise capital. And so ensuring that each systemic intermediary can withstand a significant stress on its own makes the system less fragile. Importantly, though, publishing the bank-by-bank details of the tests is really important. It promotes market discipline, and in a crisis, I think it resolves or helps to resolve uncertainty. That's certainly what happened in 2009 and is not happening now. Importantly, I think by adjusting the scenarios, prudential authorities can maintain a chosen level of resilience in the system and meet really the social needs of having a resilient financial system. But for stress tests to be effective, they need 3 properties, in my view. They have to be severe, or it's pointless. They have to be flexible. Otherwise, the tests become a mechanical exercise. We actually saw this in the United States in the case of the GSEs before the crisis. And I think there have to be some limits to transparency. I disagree with John Vickers at my peril, I know, but I think that premature disclosure, especially of scenarios, invites gaming. And so that's a really important thing. And then the question is about the models themselves, and we've had debates about that. Now, turning to the tools and the models, I have 2 big questions. The first one is, what is the value of aggregate system-wide information, which is mostly what we're getting out of some of these tools? And second, when are stress tests that employ accounting information useful? John spent a long time talking about that already. But on the first, while it might be helpful to know the aggregate level of capital in a country's banking system, possibly for calibrating countercyclical capital buffers, the distribution matters. Neil showed that already at the beginning, but he only showed us the aggregate total and the number of banks, not which banks were falling below. I can easily imagine cases where things sort of go all directions. These are not necessary nor sufficient in my view. Second, when stresses arise, accounting-based measures lag, so they tend to overstate the asset values and the size of capital buffers. Now, the NYU Volatility Lab measure of capital shortfall that they call S-risk, it addresses both of these. They compute firm-level S-risk based on the daily market value of equity for each publicly traded US financial institution. Put differently, the VLab provides high-frequency information on a firm-by-firm basis that's using forward-looking measures of equity to adjust for expected changes in asset value when shocks occur. You can aggregate the 149 firm-level estimates that they currently have that have negative values, and based on leverage of 8% and assuming a 40% decline in global equity, what you come to is a number of about $680 billion today. That's twice what it was at the beginning of the year. And it's far worse than the $100 billion capital shortfall that Neil showed in the Minneapolis Fed's tool that delivers in their worst case. Their worst case, in fact, is associated with the S-risk of 6% leverage ratio and a 5% drop in equity markets. So we're basically already there if you use the market value. Not only, but the distribution is really important. The top 5 bank holding companies account for about over half of the shortfall. So what might we do to further improve these tools? These tools are great, but I have 4 suggestions that in varying degrees have come up already. First, publish information on individual banks. Put that on the website the same way that the NYU Volatility Lab does for S-risk. Second, provide an option to adjust market capital based on the equity price to book for those banks that are publicly traded. That would be very simple to do, and I hope that it can be done with the tool. Third, I think that there is a lot of user control, and the question is whether or not it can be improved. I'll leave that for another day, I think. But fourth, I think my final point is that I want to suggest that reverse stress tests that use accounting valuations could be very valuable. What configuration of drivers of losses would actually lead to capital levels below some specified threshold? I hope that the tool could be used for that as well. I think that it's easier than to use this tool to do a reverse stress test than it would be to do it in reality. I look forward to our conversation. Thanks very much.
Thanks so much, Steve. That was great. And then, so now if we could hear from Lisa Donner. She is the executive director at Americans for Financial Reform. That's a consumer advocacy group that supports, tougher regulations for the financial industry. So let's hear from you, Lisa.
Great. Thanks so much for the opportunity to be part of this conversation, and even more so, thanks for having the conversation in the first place. To the folks at the Minneapolis Fed as part of an organization that sees changing the policies that shape the financial system as an incredibly important part of building a more equitable and more sustainable economy. We really appreciate the stress test tool that you built and the larger project of making what capital standards are about more visible. So I'm a policy advocate and an organizer, not an expert on stress testing. And I think what I bring to this discussion is that perspective, though I should add that among my colleagues at AFR are indeed experts. From where I sit, it can be pretty overwhelming a lot of the time to face the serious asymmetries that present challenges to advocacy in the public interest around financial regulation. These include huge asymmetries of access to decision makers of all kinds, of resources, and of power, including the power to directly change the way major institutions function, and the power that comes from many millions of dollars spent on lobbying and on political campaigns. But there are also pretty daunting asymmetries of knowledge about how pieces of the financial system work and what technical rules have what impact, and of transparency. People outside the system often don't have access to the data about what's going on, even when they're clear about what data they would want and what questions they want to ask of it. And related to these, but also sort of distinct, asymmetries of salience. It's obvious, for example, to the people who run banks, not just what capital requirements are, that the rules around them are very important, and that the more leverage they can use, the greater the profit and the earnings. but it's overwhelmingly less obvious to almost everyone else why it matters for them. And as a result, the policy choices and policy levers that do so much to shape the economic reality we're experiencing are often largely invisible to most people, and the results of those choices seem inevitable or impossible to change. More information and analysis alone, of course, doesn't solve the power and access and resources questions, but without more publicly shared information and analysis, it's hard to even get to the stage of grappling with them. And so we think that the tool you've created is incredibly useful because it helps to take the capital models out of the back room and gives people a much easier way to see and play with and grasp what stress testing is. And that's important in turn because it makes it easier for people to see the impact that making different assumptions and testing different scenarios can have in shaping answers about what's enough capital. And in particular, that choosing one set of assumptions could make a certain level of capital look safe, while choosing a different set would make it look pretty inadequate. And that in turn makes it easier for more people to ask tough questions, for example, about whether or not it's wise for banks to be allowed to pay dividends at a time of extreme economic uncertainty and stress, and when the entire financial system, as folks discussed earlier, is being supported by extraordinary public assistance. So a couple of thoughts for building on what you've done. I think what you're doing today actually is one example of, but it would be useful and possible to find additional opportunities to put the tool in front of more policy advocates, including people not focused on financial regulation all the time. And we'd be happy to be part of ways of thinking about doing that. I think we also think there are two directions in which the model could be built on. One's about bringing in more of the big picture, and the other is about diving into some additional details. With regard to the big picture, it'd be useful for your stress testing, the materials supporting the models, to provide some more context, basic context on how stress tests work, but also why they and the standards and decisions on capital levels they contribute to matter. What does it matter if the capital levels are not high? What's at stake here? These are things that President Kashkari and others at this institution talked about earlier today. And it's a discussion that others on this panel have made huge contributions to. And it'd be helpful for them to be a little more explicitly part of the presentation around the stress test tools. It would help make them accessible and interesting to a larger audience, and to make more of the important research and academic work in this area more accessible to people doing policy work. And again, not just to people who spend all their policy work time on the financial system, which is a pretty small world on the public interest side, but to other people who care about the economy. I think we still have a lot of work to do, despite the financial crisis of 2008 and its impact, to kind of make the basic point that the organization of finance matters to the real economy, even in the policy advocacy space. From our perspective, a fundamental question here, and in so many debates about the financial system, is whether rules are privatizing gains and socializing losses and driving inequality and precarity as a result. To us, it looks like in good times, banks pay their earnings out to shareholders, including their executives, and then in downturns, concerns about solvency lead to bailouts. They're winners and losers from this dynamic of allowing big banks to enjoy the upside of greater leverage and reduced capital, while the government and the public deal with the costs of that risk taking. Wealth becomes more over time, and in various ways, wealth becomes more highly concentrated, and the rest of us, especially those who are already in more economically precarious positions, lose out. And because of the history and continuing existence of systemic racism, people of color frequently lose out to a still greater extent. In the details lane, having checked in with colleagues very interested in the additions suggested earlier, it would be helpful from a policy analysis perspective also to have additions to the tools that would help the public explore and understand the impact of various policy decisions about stress testing, including recent ones in the US. For example, it'd be useful to be able to see how stress scenarios would play out against leverage minimums as well as risk-based capital alone, in order to understand the impact of recent policy changes around that. And maybe more complicated to do. It'd also be probably more complicated to do. It would also be useful to be able to see different versions of stress modeling that have been, further subjects of recent policy debates and decisions in the US. Could a tool also look at losses due to markets freezing up? What about the impacts on capital ratios if bank balance sheets grow in and as a result of a crisis rather than staying the same? I hope we can continue to discuss these possibilities with you, and I'm looking forward to hearing from the other panelists. Thanks.
That was great. Thanks, Lisa. That was really interesting. So now we go from somebody who's talking about the asymmetry of knowledge to someone who's right in the center of it at the New York Fed. Bev Hurdle, she's research director there at the New York Fed. So we'll turn to you next.
Great, thank you. I want to thank my colleagues at the Minneapolis Fed for inviting me to be on this panel. And before I go further, I have to offer the usual disclaimer that my remarks today reflect my own views and are not the views of the Federal Reserve Banks of New York or Minneapolis or the Federal Reserve System. I'm particularly glad to participate in today's panel because the Minneapolis tool is an implementation of a tabletop stress test model, the class model. It's already been referred to. That was developed by my colleagues Anna Kovner, James Vickery, Meru Banat, and me a few years ago. So definitely have a rooting interest there. And some of my suggestions for improvement are going to reflect the work that we did on the class model when we were developing it. So let me move, and I've talked about it in our published academic work. So let me move right into that. The first one was the one, something that Lisa just referred to, is about asset growth. The current implementation of the model in the Minneapolis Fed tool assumes flat assets throughout the stress test horizon, which of course is consistent with what's assumed now in the Federal Reserve's official, DCAST and DFAST and CCAR stress test. But we found in our model that what you assumed about asset growth actually had a pretty significant impact on the results. So it would be nice to see some toggles where you could assume, either a fixed or variable asset growth or asset shrinkage over the course of the horizon. The next another toggle that I think would be really helpful is concerns capital distributions, so dividends and share repurchases. Once again, the Minneapolis tool I believe holds dividends fixed at their historical level. But that's an assumption that, is interesting to vary. It can be varied in a variety of ways, everything from turning off all distributions towards models like in the original class model. We actually had a little toy model that we had built in that had distributions, trending towards a long run payout ratio and being able to vary that payout ratio over time. I think the historical one that we had looked at was about 45% of earnings. Of course, right prior to the to the onset of the COVID outbreak, the payout ratio for some banks was 100% or even higher. So being able to vary that is important. And in fact, a couple of my colleagues and I have a Liberty Street economics blog post just a couple weeks ago where we used the class model to look at exactly that assumption to see how much of a difference different, hypothetical assumptions about dividends and share repurchases made. And once again, those assumptions are, can be pretty significant. The final thing I'd mention is now I'll have to ask forgiveness of some members of the panel here, is a little bit inside the weeds or inside baseball, in the sense that the loan loss reserve equations built into the class model run off of net charge-offs. Whereas in the bank accounting, it's not net charge-offs, but provisions into the allowance for loan and lease losses that affect net income and capital. So you need something that takes those charge-off forecasts and maps them into, into provisions. And again, in our model, in our version of the class model, we tried, several different ways of doing this. I think it's a particularly interesting question now, sort of how much smoothing, particularly if you have something where there's a very sudden jump in your expected losses, like what are you assuming about how quickly the banks are provisioning? And that's particularly important at the moment, given the accounting change that is coming with the current expected credit loss or CECL model of doing loan loss reserve. So that would be another thing they could consider to vary. In terms of other things that other academics, or others could think about, I had some things I was going to talk about in terms of market value accounting, but I think that's market values instead of accounting values. I think that's been well covered by others, so I will simply skip over it and note that, one of the just do a little bit of a disclaimer that it's important to recognize that the Minneapolis Fed tool and the class model that underlies it are not the models that the Federal Reserve uses in its official stress testing. Those models, that is the DFAST and CCAR stress test models, use a vast volume of confidential information, thousands of data points collected, millions of data points collected, from every bank, and the models are extremely complex, driving towards a sense of precision at the individual bank level, which is important because that's the way the outcomes of those models are used to make judgments about individual banks. In contrast, CLASS and the Minneapolis Fed tool runs off of publicly available Y9C regulatory reports, available to all who want to use them, fully public data. And so, working with the basic structure of the model is something that anybody who chooses to access those data can do. One thing that I think would be particularly interesting to explore is both the class model, the Minneapolis Fed tool, and the Fed's official stress tests. The banking industry is simply the sum of what you get for the individual banks, and there's no feedback among the banks or between the banks and the economy and the scenario. And there's a lot of practical reasons for that. I gave a keynote address at the Federal Reserve stress testing conference a couple of years ago, where I talked about some of the design assumptions in stress testing and why that assumption of sort of the bank by bank approach makes sense in the context. But it's something that a model that is simpler and easy to run potentially could make assumptions and explore the linkages among the banking system and particularly between the banking system and the economy. In fact, I was at the most recent Fed stress test conference a couple of weeks ago, and Tobias Adrian at the IMF presented some interesting preliminary work using a GDP at risk framework, where he was basically looking at exactly that question. So I think there are some more interesting things that could be done to capture the links, and not just have something where a scenario plays onto the banking system, but the banking system and the scenarios inform one another. And that just takes some modeling that is not in the current suite of the class model or what the Fed is doing for its official stress testing. So with that, I will turn it back to you, Anne.
Thanks so much. That was a really great overview. And so next we'll hear from Deborah Lucas. She is professor of finance at MIT's Sloan School of Management. Take it away. You seem to be on mute.
Okay.
There you go.
So sorry. I wanted to start by congratulating Neil and Ron and their team for having created what I think will be a really useful tool. At the MIT Golub Center, we've been working on developing a number of tools to help the educated public better evaluate some very complicated policy relevant questions. Most relatedly, we've recently been looking at credit risk transfer for the GSEs and actually trying to evaluate how much risk is being transferred. We've also looked at reforming public pensions and the trade-offs and evaluating infrastructure investments. So I know how much effort it takes to create and explain even a rudimentary tool. So really kudos for taking that all on. As far as where you take it from here, I think the most fundamental questions all surround communication. Who do you really think your target audience or audiences are? Who are your likely audiences? And maybe most importantly, what do you want them to take away from it? I think that last comment is motivated by the set of concerns that Sir Vickers discussed so eloquently. So the stated goal is that it's for the public. That seems perhaps a little bit overly vague, and I don't think it's actually optimized for a broad audience at the moment. Ideally, it would communicate to different groups at different levels. So with regards to the general public, of course, most ordinary people won't want to nor have the capacity to process the information. That's okay. For the few that come across it and want to dig in, it seems important to refine the framing information a bit more. I think it's great that you kept it short and simple, but I think it needs to be more precise about the purposes of the tests and what it means for people's lives. So I was thinking about what would my rough narrative be if I were trying to communicate about these things. And I would say, well, broadly, the purpose of stress tests is to allow regulators to take preemptive actions to help ensure that banks don't fail. And of course, that is of special concern now with the pandemic, but things haven't fundamentally changed. But most importantly, stay calm. Failing a test doesn't mean a bank is insolvent, just that it's riskier than regulators think it should be. And I would also remind people, even if it does fail, deposits are insured, so you're not personally at risk of losing money. Still, it matters a lot to you because the economy is going to suffer if banks don't have the capital to make risky loans during this very downtime. So really, I think, making it very basic. To answer my own questions, I actually believe there's three main audiences for whom it will be most useful. Purveyors of information about banks, and in that category, I'd put bank analysts and journalists. Secondly, educators, and thirdly, regulators and researchers. As far as the bank analysts and journalists go, I think it's great because I think it will encourage some of them who previously felt it was too intimidating to try to take on stress testing in any detail, will find this a reason to go deeper. I would second Steve's comments that for this purpose, people are going to want to use the model to name names. And so making it easier to figure out on the individual bank data, what scenarios cause which banks to have problems would be very useful. I mean, maybe they don't have to flash out on the front page, but if you click down another level, it would be nice to know. So educators is my second category, essentially college or B school professors teaching macro or money and banking. And I think this is where it has the greatest potential to reach a lot of people in a really effective way. It already makes it a kind of a fun and easy tool to play with, so that's great. But where I think it really needs more help for the majority of instructors who also aren't stress testing experts, maybe to create links to fairly concise information on the basics rather than the fairly technical papers and materials that it links to now. So I thought a lot about what would I want to know if I were using it in a class as an interactive teaching tool, as sort of a mini case study. So if you could make it something less of a black box, that would be helpful, make it easier to understand which variables are important and sort of the basics of the whys, again, all by hyperlinks. It also is a little confusing to me to think about, well, what dimensions of the COVID scenarios are you really thinking are importantly different than generic bad recessions? And again, why? Maybe seeing how the scenarios you are putting out there compared to kind of a different colored line on the Great Recession would be helpful, so you could make a judgment relative to something that was maybe more familiar. And again, particularly as a B school professor, knowing the names of different banks would allow the discussion to be more personal. As far as regulators and researchers, I think it's a great learning resource for this group, particularly for people just coming into the area, and the comments I just made apply in that dimension. But I also think that for that group, the more technically related material that you have currently linked to is great. The articles, the code, the data, that's all going to be extremely helpful. But when I look at it and think about this, I think that all suggests that as it stands, it's probably of greatest value to this group rather than to a broader public audience or really even educators at this point. Okay, so just a final few words is it was very much in my mind as I was thinking about this, that I have ambivalence about what really can be learned about stress tests, and I'm kind of acutely aware of their limitations. And so in the interest of providing a more complete picture, a more honest picture to the public, I'd recommend adding or prominently linking to a much fuller discussion of the many caveats that have already come up in what people have mentioned. I'll give my own version as final words very briefly. Personally, I'm always concerned that too stringent testing causes banks to pull back on lending when they shouldn't, and it doesn't allow for effectively a sort of a counter-cyclical capital buffer, as many people have noted. If you can't ever spend your capital, what's it for? That's not a negative statement about capital requirements, but rather how they might be enforced and how the stress tests interact with that enforcement. I think you should comfort people that it is in fact very difficult to interpret the importance of events for which you can't attach probabilities, and maybe a little bit more on how to think about that. It's already been emphasized a lot, the over-reliance on accounting data over market data. I would also expand it to say that, well, banks are just a subset of the universe of firms that are important to citizens' financial access and health. And they create a concern that this tool isn't designed to pick up, but certainly it's another consideration. So what comes to mind again is the housing finance space. So origination has gone largely out of the banks to fintechs like Quicken. And so by neglecting that broader financial universe, you're only giving people a flavor for part of the things that they might be concerned about. So I'll leave it there. Thanks.
Okay, that's great. You raised a whole bunch of really interesting points there. So all right, well, let's go to our final speaker. This is Adi Sunderman, the professor of business administration at Harvard Business School. So let's hear from you. Thanks.
Great. Thanks very much for inviting me to be a part of this very distinguished panel, and to the policymakers both at the New York Fed and the Minneapolis Fed who've put together these great tools, which I have actually used in my own work, and really appreciate that they're out there. I think the panel has covered a lot of great points that I won't repeat. I think it might be useful for me to talk a little bit about what the various purposes of stress testing could be. And I think it's important because the way we use the stress test in 2009 is not actually the way the stress tests are currently being used. So, the way that the stress tests have now been built into the regulatory infrastructure is that they're kind of meant to set the level of bank capital in normal times. So, you're just chugging along in 2018 or 2019, and we think to ourselves, well, how bad could a bad recession be? And that's what the stress test is used for, to ensure that banks kind of have adequate capital to survive that bad recession, that we made up the scenario without really knowing too much about what a future bad recession would look like. That's quite different from the situation we find ourselves in today, which is, the pandemic has happened. We know that we're facing a kind of unprecedented economic situation. And so there's a question of what should banks do once we know that information. And that's the way that the stress tests were originally used in 2008 and 2009, which was to say, we had never had a huge nationwide downturn in housing prices. Let's use this stress testing technology to kind of figure out which banks are really being harmed by it and which banks need to raise capital. And so, one thing I actually really like about the tool on the Minnesota Fed website is that it kind of distinguishes, it has a bunch of COVID specific scenarios. I think making that highlighting that distinction is really quite important, that, we're in an unprecedented situation. And so we're taking our best guess at what the path of the economy will look like going forward. Why is this distinction important? It's important because I think once you start publishing stress test information, there's a real communications challenge around the idea that regulators might be committing themselves to something. So, in March and April, right after the pandemic hit, many banks basically pointed to the previous stress test, the 2019 stress test, which was made with no knowledge that there was going to be a pandemic. And they said, look, we passed the last stress test, we're fine. We don't need to do anything. We don't need to suspend dividends. We don't need to suspend share repurchases. We're fine because, the regulator said we were fine for a bad recession last year. But of course, in the interim, we learned a huge amount and had a completely unprecedented economic catastrophe. And so I think it's quite important that we make clear that the stress tests are a dynamic tool, that just because you passed the stress test last year with a scenario that has nothing to do with the current scenario, that does not mean that we're just going to leave the banks alone. And so, it's a little bit like the problems that the Fed faces with its dot plots in monetary policy. There, by publishing what they think the path of the economy and interest rates will look like, at certain points in time, markets have interpreted that as a commitment to those future dots, which constrains the ability of regulators to act in a data-dependent manner. So that's kind of my overarching question about this is how are we going to manage the communications of stress test results going forward? And that, that of course applies primarily to the official stress tests that are run by the regulators. But I think for these tools as well, it's worth thinking about how we communicate that just because one set of lines stays above another set of lines does not guarantee that banks are going to be fine. Just 2 points I'll make on the actual tool itself, which echo previous comments. If you put a bunch of economists together, they're all going to say market prices, market prices, market prices. I will just say that I find kind of very simple statistics from market prices useful. So, bank stocks are down about 20% since January, even though the rest of the market has recovered. I think there's some information there that we should be taking seriously. The second thing, which I'll just echo what Bev said, is I think for thinking about policy, it's very important that we see the effect of various regulatory interventions. So it'd be great to be able to turn off and on dividends, turn off and on share repurchases, and really understand what effect those actions would have. So I'll stop there and look forward to the Q&A.
Okay, that was really great. Everyone has brought a whole bunch of ideas to the table with all their very different eyes on it and very different thoughts about both the tool and more generally stress tests. We're set up for a really interesting discussion. So as we dive into that, I just want to remind the audience again of the Zoom Q&A button that you can use to submit any questions. And I also wanted to note that we have with us here as well Ron Feldman, who's the first vice president and chief operating officer of the Minneapolis Fed. He'll be here to jump in as needed and also to give us a little wrap up at the end. So I wanted to start actually with a really broad question of my own. Since the pandemic began, there's been a number of people, including actually President Kashkari and also Democratic presidential candidate Joe Biden, who have called what we have now actually a bailout of banks. And I wonder what panelists think of that. If we can just sort of level set here, is that what we're talking about? And if so, if it is a bailout, what are the implications of that? So I don't know, maybe we could start with you, Professor Sinderman, if you had some thoughts about that. And I'd really like to hear from all the panelists on, where everyone thinks we are right now.
Sure, I'm happy to kick it off. I think it's certainly the case that banks have benefited from support to small businesses and households that passed with the CARES Act, for instance. It's certainly the case that banks benefited significantly from the Fed's early intervention in capital markets and stabilizing capital markets. I would just, in the spirit of talking about big capital, turn it around and say that I think a lot of Fed support is uncertain going forward. It's not clear how much more unemployment supplements or an extension of the PPP program or any of these things we are going to get. And so if we're looking forward from a big capital perspective, I think it's important that we not assume that support be there going forward. Banks have certainly benefited from policy interventions, even if they weren't the targets of those interventions. And I think it would, a risk I worry about going forward is that without more fiscal support, we will end up with our banks being in rough shape.
In rough shape, and then perhaps needing maybe an explicit bailout of some sort. Do other panelists have thought on this? I wonder, maybe Lisa, do you consider there to be a bank bailout actually going on right now that
Yeah, I mean, I think I would echo what a variety of folks said earlier in this conversation, which is that banks have benefited enormously, both from the policies that actually helped people pay their debts and spend that were passed immediately in response to the crisis, and indirectly from the Fed's vast support for the market. So in that sense, yes. And I think, the questions for us that raises a number of questions, and one is about a very big set of questions about the sort of variety and adequacy of the Fed's tools for intervening in the economy in a crisis, and what the problems are with tools and systems that help financial institutions first and best, kind of, and what other tools we need. So that's not the case. I think we worry about the ways in which and maybe short of more dramatic changes in tools, we've certainly been raising a lot of questions about whether there should be different conditions and restrictions on some of that aid so that it's being used more effectively as a lever for job and workplace security, for example, and so that it is not being used to kind of reward and even more dramatically bail out firms that were insolvent before the crisis, and to kind of enable and empower more speculative forms of finance. And there too, I think, we're talking about banks today, but the conversation about who's benefiting goes well beyond banks. And then I guess, also worry about the ways in which that help to the financial system has taken off the political pressure for providing more fiscal help, right? If the stock market and the big banks are doing okay, then there's many very powerful people don't have the same urgency about continuing to respond to people's needs, even as many working people's situation is getting much more difficult and much more desperate as CARES Act relief has come to an end and is coming to an end. And then I guess one last thing I'll add is it also, we reflect on this in the context of the ways in which the lopsided nature of the response to the last crisis meant that big banks recovered, but the less you started out with, the longer it took for you to recover. And in some cases, for example, think of Black home ownership, people have not recovered.
Mm-hmm. So I wonder if anyone else wanted to jump in on the question of whether what we're seeing now is a bailout, or yes. Okay, Deb, I think I see your hand raised. Oh, you're muted.
I work on bailouts all the time, so I have many strong views on that situation. So I just want to point to a few things. I think it's actually not helpful to call everything a bailout, and I think this bailout has this assistance has gone not so much directly to the banks. It's always true if you hand a renter $1, you're really helping the landlord as well as the renter and so forth. So you have all these indirect effects of any kind of fiscal support. But what there was actually was massive fiscal policy through the CARES Act. And there was also indirect fiscal policy through the very large forbearance that FHA and the GSEs were able to provide to the housing markets because they are part of the federal government. But I actually think, although very large facilities by the Fed were put into place, the Fed didn't directly provide a whole lot of support. I think it's important for the Fed to help people understand that for various reasons that are important to the Federal Reserve. I also think, we should be realistic. I mean, for whatever reason, the banks have been the indirect recipients of a lot of this assistance. It was not to bail out the banks, but it was helpful to them, and people should understand that, but not kind of blame the banks for being the indirect recipients of this assistance.
Oh, and Steve, looks like you have your hand.
No, I want to, I think that's, I'll agree with a lot of what has been said before, but I want to especially emphasize a few things that Debbie just said. And that is that, that you can, there are losses, there are huge losses that are being created by the pandemic. We have to decide how to distribute them. This is a social problem and a public policy problem. One possibility is we decide that we're just going to let everybody go bankrupt now. So all the renters are going to default, which will then cause their landlords to default. All the restaurants will default, which will cause their bankers to default. So we can let everybody default everywhere. Okay, that's an option. It's not an option most of us would sign up for, but it's certainly an option. To call, I think, the fact that we've decided to support everyone's balance sheet, maybe not enough for some people, I agree, and maybe we need to do more, I agree, maybe. But to call that a bailout, I think, is not helpful. The fact that the banks happen to be at one end of the line is just because we're supporting everybody else. I think that as I think John Vickers said at the beginning, this is very different from 2008, where the banks caused problems and the financial intermediaries caused problems for the rest of the economy. This time what's happening is that the rest of the economy, the real economy, is where the problem is, and we don't want the real economy to cause the banking system and the financial system to collapse. So I think that's really important. I think to keep that all in mind. Now, does the Federal Reserve exist to support the financial system? Yes. Does it exist to keep it from collapsing? Well, yes. Should it keep banks from failing if they're illiquid but solvent? I think so. And then we sort of go on for there. I have some complaints about what the Federal Reserve has done, but I'm not sure that's really relevant right now.
Okay, so it sounds like we have a bit of a divided opinion on whether to term this a bank bailout or not. But I mean, if we think about the tool that the Minneapolis Fed has developed here, and we're sort of taking a close look at, does it tell us? Can it be useful in telling us in this context now, where there's been so much assistance to the broad economy, funneled through banks, as the point has been, does it tell us now about the health of the banking system, and whether or not, I mean, does the tool lead to better policy? Is it a way to get better policy? I wonder, who might want to take that on first. Okay, Bev, that'd be great to hear from you. Thanks.
Yes, I didn't weigh in on the last one because what I was going to say, I think would have been said about the bank sort of being the channel, but not the ultimate end of the game. In a sense, we only, it's not too much of a dramatic to say we care about the banks because we care about the economy rather than caring about the banks, in and of themselves. Yeah, I mean, I think there's a couple of ways in which tools like this can lead to better policy. So there's the immediate, we are now in the middle of something and we need some way of assessing, given all of the fiscal policies, regulatory relief, other things that have happened, temporary changes to some of the leverage requirements and liquidity requirements. What does that mean for the banking industry as all of that filters through the economy, so we can have more up-to-date knowledge, again with the caveat that this is a tabletop stress test model that makes a bunch of simplifications that then enable the quick and easy running. So you're gonna miss some stuff potentially, but it makes better, the information that everybody has is better. I think there's a second and perhaps more subtle way. This is, when the Fed or any of the agencies released a proposed regulation, proposed change in capital requirements, liquidity requirements, whatever it is, those go out for public comment, as is required in the United States for regulation. And, I've been involved in that process as an economist, not a lawyer. And I've seen you put out a regulation and you get hundreds of comments. If there's 100 comments, 97 of them are from banks or banking consortiums, basically saying, why if it's a more stringent regulation, why that's a bad idea. We may have one from AFR also, on the other side, and a couple of academics will weigh in. Very often they weigh in by saying, here's my paper on this topic. Not really helpful, because usually the proposed regulation has a set of very specific questions. So there's, you've got this balance of, who's really engaging in that process and who is not. So the hope would be, I think one hope would be that tools like this on the outside that permit more, it's not really independent because it's a tool that's being provided, but more other ways of looking at the question and understanding what some of the implications might be, and doing counterfactuals, that can be weighed in by parties into the regulatory review process, I think would be incredibly helpful.
So I take your point, and I think that a lot of the panelists also raised the issue of, what audience is this tool useful for, and how could it be used? What are the implications? I must say, when I went in and checked out this tool for myself, I immediately went and tried to turn on whatever levers would create the most banks falling under their required capital level. And I think, as a just to sort of see what would happen, and to the point of many of the panelists that, it'd be interesting to have other tools in there. It might make it very complicated to build it. So I do wonder, and this is a question from, our audience, does having tools available like this, undercut perhaps what regulators are trying to do, and perhaps do some more harm than good, sort of second guessing, I guess. And I wonder if anyone had any thoughts on that, and perhaps it also relates to some of the issues about transparency that some of the panelists were talking about earlier. Let's see, I'm trying to think who hasn't. Okay, well, Adi, since you raised your hand, maybe I can ask you.
Sure. I mean, I think just to kind of start with what Bev said, I think getting more people involved would be helpful, because we need somebody out there advocating for not the bank point of view. And sometimes that's academics or think tanks and things like that. But giving them the tools to make those arguments, I think, are helpful. I guess this helps segue into, one broader thing you could think about doing with this website is not just providing stress test type information, but basic summary statistics. Like, to me, it is pretty crazy that, you know, the last 6 months have seen the most equity issuance by non-financial US firms ever, and yet banks are still paying dividends. That's just a fact that suggests, you know, we can't forecast exactly where the economy is going to go. We've never had a worldwide pandemic with this much leverage built into the system. And so, you know, to me, the strongest kind of motivation for thinking about tightening up on the banks a little bit is just a precautionary one. We don't know what's going to happen. And so why not just suspend dividends and repurchases and maybe issue a little equity? It doesn't seem that costly. And so to the extent that you could put together some basic facts like that, in addition to the stress testing technology, and really let people kind of form their own views, I think that would be helpful.
It looked like Steve, you had your hand up, and then Deb, maybe.
I have 2 points. I mean, first of all, it's something that's sort of related. I think we should think about stress testing differently in normal times than in stress times, than what Till Sherman referred to as peacetime and wartime. And this comes to some of the comments. I think Adi made some comments about cyclicality problems and then what we can learn. We learn different things at different times. And I think we need to keep those things pretty straight. On this issue about more harm than good, I think this comes to John Vickers' comment about the fact that transparency can't, in cases like this, it's hard to argue that transparency is bad. Arguing that transparency is bad is an argument that somehow I should put my head into the sand and ignore information. That makes no sense to me. What does make sense in this case is to ask what the relationship is between the output of these tools and the stress tests that then come from the DFAST and the CCAR. Now, I'm a big fan of what Bev and her colleagues have done, but I confess to not having gone back and looked at the details and whether or not they're benchmarking their models output to the outcome of the DFAST and the CCAR. But that would be really, really useful. So if I knew what the difference was, I mean, people did this with S-risk at one point. They did benchmark the S-risk stuff, and they said that it does forecast at high frequency what's going to come out of the CCAR. Is that happening here too? And that's something that it seems to me would be, that's something the research guys are going to have to do, but then it would be really useful to know. Bev probably knows, and she's going to tell me that it doesn't work.
No. So in our academic paper in the Journal of Banking and Finance, we looked at a correlation, and what came out of class, which is a different implementation than this tool, was correlated with the official stress test numbers, but the levels were different.
Yeah, that's pretty common actually, that the levels are different. I think in the other things too.
So, and I thought I saw Deb Lucas, that you had your hand up to.
Yeah, I just was going to quickly add, I second everything that Steve and Beverly said. I just wanted to point out the fact that if you do play with it, it's so difficult with the current parameters to make things go negative, speaks to actually the neutrality of the tool, because I think this group has a predisposition some people have a predisposition in favor of higher capital requirements, and you wouldn't necessarily come to that conclusion from the way it's set up. I think the banks could even write more comments based on this tool saying, look, you know, these are really extreme scenarios, and even that it's not breaking the system. So I think that's actually a good advertisement for it not leading the witness, so to speak.
That's a really interesting point. Sorry, Lisa, you're.
Yeah, I was just going to chime in, I think, to underline 2 things that Beverly and Adi both said, and one is, I think that, you know, the usefulness of just increasing the set of public interest commenters who can engage in the regulatory process, and giving them more tools for doing so effectively. I think is incredibly important because otherwise they're really, it is very, very, structurally, the system can very, very easily become, and most often is, largely kind of a closed conversation between the regulators and the financial institutions. And so enhancing the capacity of even, the expert public to engage in detail with the regulatory process is incredibly valuable. And I think a lot of people's comments over the course of the day have, for example, focused on this dividend question, and I think that provides a good example of a place where being able to play with this stuff enables more people to think about those decisions by the regulators. So making the tool easier to use for engaging in the regulatory process, I think makes it even more useful for having a policy impact.
Right. So this was something that came up a number of times. Maybe having a toggle, I think, was the word that Bev used. That you could say, hey, what would happen if I prevented banks from paying out dividends, or how would this change things? So I think that's really interesting. And then on the other side of the metrics that are going in into this tool, that and I think this will be the last one of the last questions before we hand it over to Ron. But what other, it has a number of market measures in there, right? That you can kind of set according to what you think, where bonds might be or what might happen with house prices. Are there other types of financial market measures that could be used in in this tool, and would they be helpful in some ways if we have some ideas there? Does anyone want to? Okay, so Professor Lucas.
So actually, there's people have been talking about a lot of the measures that are out there. And so I think the interesting question for the feds is whether what they're trying to do is just represent things that the Fed is officially using, or whether they actually want to create a dashboard that I think would actually be more useful to the public, where they could be clear, well, this is what we do with our stress tests, but a lot of people are interested in market-based measure, and here's another piece of this dashboard. But it would have to really be a separate thing, because the hybrid wouldn't work, I think, for a number of different institutional and communication reasons.
So interesting. Okay. And any other thoughts there from panelists particularly about any financial market measures that might be useful, or other aspects that would improve the tool that we haven't? Okay, well, so then let me just ask another question, and I think that a number of you, including Lisa, did talk about different audiences that this could be targeted at, and also how it could be used as far as communications and helping people understand what might the ramifications be of banks falling under certain capital levels. And I wanted to ask you, Ron, have you thought about doing this, and how to make this information more accessible and useful to broader audiences?
Well, thanks, Anne. I appreciate it. And before I answer the question directly, let me just thank all the panelists, thank Sir John Vickers for his keynote address, and thank a number of people at the Fed who, I won't try to name them all, but it takes a lot of work to put something like this on. So I really appreciate all the hard work that they did there. And I think we were already thinking that we were invested in the work that you've seen. And I think one reason we brought together a group of really smart and distinguished people who we haven't really talked about these exact set of issues, was to get their take on what we should do. And what I heard was an affirmation of the direction, and we are going to devote more time and resources to respond, I think, to hopefully virtually all all of the comments that we got. And let me just try to summarize about what I heard some of the next steps are. So first, there was a variety of comments about communication, and I'm going to put them in two buckets. One is that we need to do a better job, and I think anyone trying to use these tools needs to be really clear about the case for doing it. Why are you doing this? Why is this interesting? Why should people care? And I take that on board, that we need to do a better job of motivating, not just to the roughly 100 or so people that tuned in today, but to the broader audience. And by the way, I think 100 people for this topic is actually pretty good. So I didn't mean that as something negative. I actually view it as pretty positive. So there's the why. We heard that from many of the panelists today. And then there were more detailed questions about communication, more precisely which audience, how do you how do you show the information? And let me maybe get back to one of the questions, Anne, that you asked the group, which is, was there really a bailout or wasn't there a bailout? And I think that really gets to some of this issue of communication. On the one hand, some of the panelists pointed out, well, maybe not technically. On the other hand, going back to what Sir John Vickers noted, and I think Adi and several other panelists, if you look at the stress test as it existed last year, many of the banks look at that and say, oh, we're fine. There is no problem. So, one reason why you might want to not focus on the technicality of whether it was a bailout directly to them or not is that that's the exact kind of language that helps people understand who is the recipient of the government benefits. Whether they were the intended recipient or not, they ended up being the recipient. And it prevents banks, for example, pointing to last year's stress test to say, don't worry. So that's just maybe an example where language really matters a lot, the specific language we use. So we need to be very careful about making the case and then how we communicate it. So that's one set of comments that we're going to have to work on and respond to. A second was, and maybe just one just add on to that, this question about showing specific banks, don't showing specific banks, that's really an issue of communication, right? That's really what that's about. We did put the code out there. And let me just say special thanks to Bev Hurdle and her colleagues for putting together a model that was the basis for what we did. That issue of should you show specific banks or not is something we talked a lot about. And I think, there was clearly overwhelming desire to do that, but is that really we need to think about how to do that effectively and have that fit in. I'll make two other comments. One is, I think the reason why there was so much focus on financial market data in a conference about transparency is precisely that regulators don't control that data. That data comes from other folks, and it's inherently, at its core, it's not accounting. It's based on things that central banks don't control. And so it's always providing a check. So I think those comments were well received, and it's just a matter of how we need to figure it out. And then the final comment that honestly we hadn't really thought about, which is the whole point of being inclusive here and getting people to give us their views, is I think we've largely been thinking about the stress test tool while we're not trying to replicate what the official results were. And as Bev noted, we don't have the data to do that. That wasn't the intent. We did try to think about how to make it more similar to the official type analysis than not. So for example, the kinds of things you can choose in the scenario are things that are picked in the official scenario. I think feedback we got here was, well, something, you're a bit liberated from that, and you can do things that they can't do in the official scenario. So for example, if you're running the official scenario and the official test, you have to make a decision about whether the balance sheet's going to grow or not. You need to make a decision about dividends or not, et cetera. Well, we don't have to do that. I mean, we have the benefit of not having to do that. And I think that's a really important area for us to explore, because a lot of the questions are not about, well, if you made the equity drops a little bit bigger, what would happen? A lot of questions are about, if you changed the underlying assumption that we're seeing in the official test, what would happen? And I think Neil Kashkari made that point up front when one of his questions to John Vickers, well, what if you could toggle with what kind of financial support is going to be provided to the economy through the fiscal authority? So that's something I think we hadn't really thought about. And one of the benefits of this conversation was that now I think not only do we have follow up on the specific recommendations you made that were already in train, but now we've got follow up on things that we hadn't thought about at all. And I think we'll do that. So I will bring the meeting to a close by again thanking all of the panelists, thanking Sir John Vickers for the keynote, and thanking everyone at the Minneapolis Fed who helped bring this on. And I think maybe I'll just leave it as more to come from us. And we welcome through the stress test tool, there's a place where you can send us emails. So if you've got ideas that didn't get raised today, we would love to hear them. So thanks everyone, stay safe and well.